Right here you see starred what basically needs to be done by Tuesday morning upon coming to class. Tuesday morning, it's a great store if you've never been there. A lot of them in the Twin Cities. Problem 5-1A, I'll start with you right now. I'll expect you to do problem 5-1B by Tuesday morning. Problem 5-3A, they're asking us to do owner's equity statement, balance sheet, and multi-step income statement. Let's just stay exclusive to the income statement. You, of course, would do the B problem as well. I'm right now on the fence about this extra one. I think if we're feeling like we need extra help and extra practice, that would be a good one. But without further ado, let's get rolling. This is just some of them. There's a whole other page of them. So there's a lot of transactions. More so than ever, you really got to pay attention to dates and businesses, okay? If you want to just lightly mark in your book kind of what I do, that's really okay. Just because we're dealing with many businesses and many dates, we're purchasing and we're selling. When we're purchasing, inventory has a lot of masks, okay? When we're selling, it's a lot of transactions. Anytime you see the word sold, it's what? How many transactions? 2. Somewhere, and I made these notes to myself, and I think it'd be worth adding them to your margin somewhere. Hang on just a minute. Anytime we're purchasing inventory, so we're buying it to resell, I'd put this somewhere. It's going to help you. We've got this inventory account we're rocking, which of course is an asset. So an asset has a debit increase, a credit decrease. It'd be a plus when we purchase. It'd be a plus when we pay freight in. We know freight out is an expense. When it's freight in, that means it's FOB shipper. It's free for the shipper. The buyer is paying. If it says FOB destination, it's free shipping, just like all the online promos right now. Some things that are masked by inventory that are subtraction is when we have a purchase, return, or allowance. So we send back something that we don't want that's actually masked as inventory. And another one that makes inventory go down is when we pay early on our AP as a discount. All inventory, it's just what's plus, what's minus. And then the 2 tangibles are these. Like I can physically touch when I purchase the inventory and it comes in. I can physically shove it out the door in that FedEx truck when I send it back. I can't really touch the freight in. I mean, I see the FedEx truck coming, but it's not like I'm touching that inventory. Like I'm not getting more inventory. It's just the value of the inventory is going up. The value of my inventory is going down when I get a deal. Okay, that's all from the purchasing side. When we're selling inventory, first it's usually ×2 because we usually have the revenue transaction and the COGS transaction. When we're selling inventory, we've got sales revenue, which has a credit balance, but then there's this 2 contra accounts plus COGS that are now separate. We have COGS, we have sales returns and allowances, and we have sales discounts, which all have debit balances because they offset that credit revenue. That's basically the chapter in a nutshell. It's just when we're buying, it's all funneled into inventory. When we're selling, it's revenue with all these contra accounts. You probably have a favorite. I favor this a little bit more because it's less journalizing, but I favor this side on the selling side because it's just blatantly put into different accounts. You got to know both. Let's do a couple transactions here before you leave. I'm on page 258. Powell's Book Warehouse distributes hardcover books to retail stores and extends credit terms of 2, 10, and 30 to all of its customers. So you might not see that in the transactions because up in the directions it told you. At the end of May, Powell's inventory consisted of books purchased for $1,800. During June, the following merchandising transactions occurred. So basically in May, we were ending with an $1,800 balance. In June, we bought more, sold more, returned, gave discounts, and everything in between. Okay. If we purchase books on account from Klein Publishers, FOB destination, terms 2, 10, and 30, and there was a cash payment for freight on the date, what would the transaction be? Now there's some shenanigans going on in that transaction. We bought books for $1,600. Did we pay cash? How do you know that we didn't pay cash? Because it said terms and it said on account. Did we pay shipping? Free shipping! Woo! Because it's FOB destination. So then why did they put the $50 thing in there? Just to confuse you. Because who paid the $50 shipping? Klein Publishers, not us. Had it been us, it would have been an increase to inventory and a decrease or an increase to AP in this case. So all of that verbiage, and it's simply inventory went up by $1,600, AP went up by $1,600. We got the inventory, the asset went up, we now owe more. Folks, that's all I'm going to do on the recorded transactions. And so is that an okay pace? June 3rd. We sold books on account to Reading Rainbow for $2,500. The cost of the books sold was $1,440. I see the word sold. You circle the word sold in the book. It'll help the group next time. Okay. Sold tells me 2 transactions. We have to update revenue, and then we have to say it wasn't free, cost of goods sold. AR went up. Apparently, we sold books on account. When we sell, what's our credit terms according to the little verbiage at top? 2, 10, and 30. Okay, we sold them to Reading Rainbow, and then revenue went up. A contra revenue account that's going to offset that $2,500 sale is cost of goods sold went up by $1,440. And the only thing going down, what has left the building? In this case, books. Our inventory went down. What happened on the 6th? We received $100 credit for books returned to Klein Publishers. So on June 1st, we bought books. Now we returned some of them. Do we owe as much anymore? We are going to see a decrease in accounts payable. What is also gone? A book. Was it one book? Okay, $100 worth of books. I want you to make a quick T account for the AP here. We originally purchased $1,600 worth, but we just returned $100 worth. So our rockin' balance right now is really $1,500. I think next one will be a nice place to stop. Paid Klein Publishers in full, less a discount. Okay, let's just look at their discount period. When did we buy the books from Klein? June 1st. We paid them on June 9th. Back up in June 1st, they have a deal that says 210 and 30. So did we pay within the 10 days? What does N30 mean? Basically, the bill is due in 30 days. Because we paid within 10 days, this $1,500 balance we're rocking, we get a 10% discount. Accounts payable is going to go down to $1,500. We saw that. Okay, so if we were rocking a $1,500 credit balance, if we put debit there of $1,500, we now owe them what? Nothing. That's good. Did we pay them $1,500? We took that balance of $1,500 times 2% or times 0.02. We actually paid them $1,470. And our inventory went down. Well, did we hand them over $30 worth of books if inventory went down? No, it's a mask. The value of our inventory went down by 30. We didn't give them $30 worth of books. So awesome job. That recording will be there, but then I'll just add right to it